It turns out the UK economy has been underperforming this year. The latest figures from the ONS show that GDP growth in the first 3 months was just 0.1%. This is down from the 0.4% at the end of last year, and the lowest it's been since 2012. The slowdown in growth is mainly from a sharp reduction in construction output, while the terrible weather we had a couple of months ago has also had a minor impact. The UK stock market hasn't been at all fazed by this slowdown in growth, and in fact the FTSE 100 has had its best month since July 2013. There's been big news in the supermarket industry, as two of the biggest names, Sainsbury's and Asda, have announced they're planning to merge. If the merger goes ahead, then the newly formed retailer will overtake Tesco to become the biggest player in the sector. Sainsbury's shares have soared in value since the news broke, and by the end of the month they'd increased by nearly 30%. Very much in the money. As I mentioned, it's been a great month for the UK market, with the FTSE 100 index gaining nearly 7%. European stocks have also performed well, with the Euro Stoxx index climbing around 6%. US stocks, on the other hand, have not had such a good month, as the S&P 500 index has risen just 0.4%. Commodities have performed well, in particular crude oil, which has gained around 7%. And in the FX market, the pound was badly hit by the poor growth figures, as it lost around 2% versus the dollar. The Bank of England has its next monetary policy meeting in a week's time, and there had been plenty of speculation over possible rate rise. However, since the poor growth figures were released, it seems unlikely that it's going to happen this month. So the chances are we'll have to wait until later in the year, or maybe even next year, before we do get a rate rise. We maintain very low interest rate risk in our funds, so they're unlikely to be badly hit by falling bond prices should there be an unexpected rise.